So guys, before starting, a small word to say that this is my first video on YouTube. So quality or subtitles or audio mismatch errors might occur. Please try to adjust and I will improve with upcoming videos. One random Monday is you're sick of your boring college life. You want to do something productive. So you think, let's do stocks. Boom. You search YouTube. And what do you find? A bunch of videos yapping about support and resistance, secret setups, and 100% success trades. Total crap. So you try their super secret 100% success setups, and boom, your money's gone. Not because of your skills, but because the setup was trash. Now what? You panic. You join some random Telegram signals group hoping to recover. Another boom. Account blown again. And now you're sitting at zero balance, or worse, negative. Now want to sit back, take 2 deep breaths. Let me be honest with you. There's no way some random YouTube guy can make you rich. If you really want to be a successful trader, you've got to understand the market. Learn the basics, master the core, one topic at a time. And here's the bitter truth. These topics aren't on YouTube. Why? Because no real successful trader is going to hand it out for free. All you'll find are scraps, support and resistance, wedge patterns, candlestick tricks, useless stuff. The only real way to make money in stocks is by understanding the core concepts and putting in hours of practice, trial and error. And even then, your win ratio will be just 50 to 60%. So let's end all this pessimistic bullshit and get into the real stuff. I'm still learning too. I make like 250 to 500 rupees a day. It's not enough and the risk is crazy high. But the knowledge I'm sharing, it's real. It's factual. No fake-ass content. Honestly, I could have sold this. But let's be real. I'm not a big name. I don't have fancy money to run Instagram ads or build some brand. So I'll keep it raw. I'll give you what I've got. And maybe YouTube pays me. In simple word, this is a give and take deal. Now the thing I'm going to cover, I'll start super simple. What is the market? How it works? What the chart says and what it actually has? What are candlesticks? What are higher time frames and lower time frames? And how do they coincide? Different types of trading, intraday, options, binary, forex, etc. What's buy, sell, call, put, take profit, stop loss? What's support and resistance? Then we get into the real stuff. Market structure, CHOCH, BOS, MSB, internal versus swing logic order blocks, refined OBS, entry OBS, mitigation, breaker blocks, liquidity, buy-sell stops, liquidity voids, inducement, internal versus external imbalance plus fair value gaps, OB plus FVG combo logic, core concept integration, liquidity plus OB plus FV, G plus MSB combined setups, higher time frame mapping, top-down analysis for binary precision, entry models, risk entry versus confirmation entry, binary expiry setups, inducement mastery, sweep arrow, OB, arrow sniper entry, stacking breaker blocks and mitigation, smart money trap logic, kill zones and session timing, London, New York, Asia, plus volatility zones, strategy stacking, CHOCH plus OB plus liquidity plus FV, G confirmation models, multi-time frame sniper entries, psychology, discipline, dopamine, tilt control, decision clarity. Chill dog, I ain't gonna teach all this in one day. I don't make much money, and honestly, this takes a lot of time. But for now, let's see what we're actually going to cover and what you need to understand. Market example so that you can understand quickly. Let's say Mr. Trump runs a burger shop. His burgers are super famous, and his business is very profitable. But he has a problem. His shop is small, just one outlet, and it's always crowded. Now Trump wants to expand his business, open more outlets, but he doesn't want to take a loan or sell his property. So what does he do? He goes to Modi and says, bro, I'll sell you 20% of my burger shop shares. You give me money to expand. Deal is done. Trump gets money for expansion, Modi gets ownership. Now every time Trump sells a burger for 100 rupees, Modi automatically gets 20 rupees because he owns 20% of the business. That, my friends, is the basic and actual way the market works. People buy and sell shares of businesses to share profits and growth. Trump, the burger shop owner, company, business owner, promoter. He's the guy who creates the business and then offers shares to raise money. Modi, who buys 20% shares. Investor, shareholder. He provides money in exchange for ownership, equity. So in stock market language, Trump equals promoter slash company, Modi equals investor slash shareholder.
Let's break it down. Now that we have the most basic concept of how the market works, let's dive deeper into what is market. As we understand how the market works in reality, we also gotta understand how we, intraday traders and binary traders, actually make money. Let me be clear, investor and trader are two separate guys. Don't ever think they're the same. An investor looks for long-term options. For example, a guy who bought shares in Facebook back in 2012, when it first came out. At that time, the price was just 2,090 rupees. And today, it's worth 66,300 rupees. Quick math. That's a profit of around 64,000 rupees. That's how investment works. But as for a trader, we only have power over the stock for a single day. In binary trading, we don't even hold the stock. It's all about prediction and timing. So, here's how trading looks. Today, Facebook stock price went down to 64,000 rupees. After some research, you figure out it might bounce back to 66,000 rupees. What do? You buy the stock at the low 64,000 rupees. Then you place a stop loss at 64,800 rupees, close to the bottom. And you set your take profit around 66,000 rupees. Now, price moves according to your plan, and boom, you made 2,000 rupees. That's how trading works, and don't worry. In the next classes, I'll explain terms like stop loss and take profit.
I'm not going to teach you about investing right now. We'll stick to intraday trading and, more importantly, binary trading. First of all, the most basic stuff. You already know about the Bombay Stock Exchange, the National Stock Exchange, and Sensex. If you don't know, just Google it or ask ChatGPT. That's your homework. Now, the next part is knowing who are our brokers and how much commission they take from us, including those hidden charges. Personally, I use Money and Angelone. You can also check out Grow and others. For binary trading, there are platforms like Quotex and Pocket Option. But here's the key point. Do your own research and find the best one for you. Important, don't fall into scam apps. For intraday brokers, make sure they are SEBI registered. For binary, remember most are OTC markets, so be extra careful. Alright, enough talking. Let's dive into market charts and whiteboard breakdowns.
So let me explain, what are candlesticks and how should we read them? Most traders use the most famous chart type called the candlestick chart. We don't need to go into who created it or the history. Let's stick to what actually matters. A candlestick pattern consists of two colors, usually red and green. Now don't confuse this. Red does not automatically mean sell, and green does not automatically mean buy. Each individual candle only tells us four things: the price at which it opened, the price at which it closed, the highest point it reached during that session, and the lowest point it reached during that session. That's it. A single candle says nothing less, nothing more. Candles only gain meaning when they are combined. For example, if you see 10 red candles continuously going down, you can say the price is being pushed down by the bears. Now, bears and bulls are just trader terms. Bears represent selling pressure, while bulls represent buying pressure. Finally, a candle itself is divided into two parts, the body and the wick. The body shows the opening and closing price of that session, while the wick shows the highest and lowest points reached. Now I'm looking at the Nifty chart, and as you can see, these are the buy and sell options. These are some tools given by the broker for drawing and marking. That's volume, and this indicates the price. Now I'll use the trend line marker to draw on the chart for better understanding. These are some of the options you can use. First of all, I'll mark one end at the extreme point in the flow of direction, and the other end I'll close with the next extreme, which is opposite to the first one. Then I'll continue this process till the latest candle. I'll also draw a reference line so that you can see the price has not broken the flow. I might adjust this point a little for better visibility. Now here comes the important part. The extreme point against the flow or trend is called a lower high, and the extreme point with the flow or trend is called a lower low. When the price goes up briefly and then comes back to break the previous lower low, and maybe even touch the previous lower high without breaching it, we call this pattern a strong downtrend, or in simple words, the bears are in control. Let's understand more clearly with the board. So I have drawn a downtrend. This blue line explains the previous lower highs. The price should not breach this point. If it does, there is a chance of a shift in the market trend. So price should not breach the previous lower highs. Instead, it should keep going down, making new lower lows. These new lower lows must not breach the previous lower highs, but continue pushing down. We can see price is in a solid downtrend. Now, price made some upward moves. This is called a retracement. It happens due to exhaustion of price and also to fill the imbalances. We'll talk more about that in later classes. Here, price goes down, retraces, then goes down again, retraces again. But these retracements should never break the previous lower high. And the new lower lows should always break the previous lower lows. Now let's talk about the uptrend. I'm drawing an uptrend here. The uptrend is formed with higher highs and higher lows. Each new higher high is followed by a higher low, and this pattern continues. This line I'm drawing shows a retracement. That's when the price pulls back a little, moving down even though the overall market is going up. Retracements usually happen because of exhaustion or to fill imbalances, but we'll discuss that later. In an uptrend, the price should not break the previous higher low. It might touch it or come close, but if it completely breaks below, the market trend might be shifting. So protecting that higher low is very important. Now looking at the chart, we see price forming higher lows, and each new higher high breaks the previous higher high. That's what confirms the uptrend. Here, notice that the price touched the previous higher low, but didn't close below it. After touching, it bounced back up. So we still consider this an uptrend. This shows us a strong uptrend with higher highs being created and retracements respecting the previous higher lows. Now let's talk about consolidation. So in consolidation, price moves sideways, meaning price is confined between two lines. We can call these lines support and resistance, but primarily for now, let's just call them two lines. Now we can see the price has touched that point and went down, and when it came down, it again touched the point and went up. The same goes on for some time. So here, we can't be so sure whether it is an uptrend or a downtrend. The market keeps doing this until bulls or bears take control. If bulls take control, it goes up. If bears take control, it will go down. So the best point is, we should never trade in consolidation. I'll give you an example right now. This one is called a double bottom because the two bottoms have touched the resistance and the price broke above support. So what do we generally think? The price has gone up, so I'll buy here. But that's not correct because the price is just acting. The price is trying. That's just a fake out to catch liquidity. The price then goes way down and closes bearish. This is just for a double bottom. There's plenty of other stuff that goes on in the market. So with this, I hope you got very good clarity on uptrend, downtrend, and consolidation. So I hope you got a clarity on what is consolidation, uptrend, downtrend, and all the previous topics which we have covered. This is very basic things. If you haven't got any clarity or very small doubts, you are not going to make it. So make sure that you understand every part of it. And also, this is basic, so I am not covering this up to full extent, but you will understand with the flow, so don't worry about it right now. And another thing, the market won't be always like this. Let me show you. The market will never be like this. This is the classic uptrend you are seeing right now. But the market never will be like this. Market will be like this. So you never should think that you will see a textbook accurate downtrend or uptrend. And the consolidation is kind of pretty much same. It will be like this only. It will be stuck between two lines all the time. No one cares about it anyway. So now that we got clarity on what is uptrend, downtrend, and consolidation, let's move to the basic topic. Let's move to the next basic topic, which is, wait a minute, let me show you. What are time frames? So we can see this is a classic downtrend, lower highs, lower lows, lower high, lower low, lower high, lower low, and boom, there is a strong rejection here. And if this thing actually, let me show you, this isn't your top topic right now. But let me show you, this will be useful if this one breaks this line. If this thing is going to break this line, we'll call it as change of character, meaning earliest sign of reversal. Sorry, let's stick to the basics right now. So we'll be seeing binary options in this. We'll be having so many time frames, 5 seconds, 1 minute, 5 minutes, 15 minutes, 1 day, 1 hour. So my classic thing is I'll go with 1 hour and I'll see the market is actually in the downtrend. And price, as you can see, price is trying to make past previous lower high and price is falling down. So I'll confirm this as a downtrend. Then I'll go to 15 minutes chart and we can here see this as a consolidation. But in reality, this isn't consolidation. The price is going down. Let me show with more clarity. See, as you can see, price is still going down. Going down, going down. So I'll be marking what we know. OB, basically, we are going to just mention order blocks or liquidity sweeps here. And the main thing is it is going to happen in 5 minutes chart. So we can see that. In 5 minutes chart, we will be marking our F, V, G, OB, ROB, etc. Every stuff we are going to learn, we are going to do. Here, the only thing we're going to do in 1 minute time frame is looking for confirmation candles. So as you can let me show you, what are confirmation candles? Minute. So as we can see here, there are continuous green candles. Now, some people might call this as a swing, but for you, I'll call this as 3 white soldiers, because let's consider this as a single candle. This as a single candle, this as a single candle. So this will be a 3 candles. And here we can see this is called bearish engulfing pattern. So here we can see this candle is completely engulfed. So we will call this as bearish engulfing candle. And then the very next candles have gone down, and we can see this as a hammer. After a hammer, we see a green candle, then a long leg doji. Then again, boom, there's a solid downtrend. So right now, these are some dojis. We don't care about dojis. Honestly, we can call this as an exhaustion candle. The very next candle is going to be a red candle. Let me show you there is much time for this. Let's leave it. So this isn't a complete bullish engulfing. Actually, we won't see textbook things all the time in market. We just got to assume many things for now. This isn't a textbook accurate bullish engulfing, but this is still a bullish engulfing because we can see some uptrend. And this is called a swing, another classic bullish engulfing example. So these kind of bullish engulfings are called as confirmation candles. There are plenty of confirmation candles, but the major ones are Morbozu, bearish engulfing inside-out candles. And these fidget spin, long leg dojis.
So that's where I'll close my first video. You've learned the basics of trading. You should now understand the market, its mechanisms, and the key players involved. Remember, investing differs from trading, and each style holds its own strategies. We've covered trading styles and core concepts like uptrends and downtrends. Consolidation and time frames are equally important in your trading journey. If you have questions or doubts, drop them in the comments. I'll do my best to answer them and engage with you. If we reach over 500 likes, I'll release part 2 with deeper insights. Your support means the world and helps me create more for you. Thanks for watching, and let me know if I missed anything. I'm eager to bring you even more insights next time. So stay tuned, and see you in the next video.